Good morning, everyone. Good morning, everyone. Shall we now start with the problem solving part, friends? Alright, friends. Now you take through this question. I'll give you a minute time. Please read through the question, understand the question, after which solving part we will do it together. Fine, friends. This question we are having the market return also, and we have an aggressive portfolio also. Then they are asking us to find out the beta. Friends, beta can be found using three formulas. This question I will solve it and I will show you the formula for beta using four formulas. One more new formula I will teach you along with this question. So shall we start doing it together now? Alright. So I'll write down working note 1 beta using formula 1. Exam 1 formula is enough, but when we are doing over here I want to show you that all the answers with any of the formula finally tallies. Alright, okay, so in this we will go through the same table format: x, m, xm and m square. Alright, x will be 440 and average will turn out to be 22. M will be 725, average will be 16, 28, 1000, 1028, 49, 625. I get the answer as 674. So the formula will be sigma xm, that is 1028 minus, outcomes are only 2, x bar is 22, m bar is 16, whole divided by sigma m square minus 2 into 16 into 16. Let's try solving it this way, friends. I'll get the answer as 324 divided by 162. So the answer will turn out to be 2. Can you please write down till here in your books, friends? Sajuddin, you slept off. Do one thing. Let the time come to 2 o'clock. You take that and this. It's a complete portfolio session. If you wouldn't have understood the concepts, you will find it difficult and it will be demoralizing for you to attend this lecture. Instead, what you can do is you can first play the earlier video. The chats are anyways there. Your doubts will only get held up. And then you can do this. After that, because this session is mainly problem solving. So without the basics, it will be very difficult for you to understand. Once you're done, please chat and let me know that you're done. Alright friends, I will now do the next working note, beta using formula 2. Beta using formula 2, that is covariance of xm divided by variance of m. So friends, here the table format for covariance will be x, m, p, x minus m bar. Let me take a fresh page. X, m, p, x minus x bar, m minus m bar, p into x minus x bar into m minus m bar. I will get the covariance over here. If I do p into m minus m bar the whole square, I will get the variance of m also here only. So in one table I can finish off both the things rather than putting m, p, m minus m bar into p the whole square. Okay. So the numbers over here would be 440, 22, 725, 16. Friends, probability is not given. When probability is not given, we assume it is equal probability. So here it will turn out to be 0 0.5, 0 0.5. So I'll be getting the answer as minus 18 plus 18, minus 9 plus 9, 81, 81, 162. So here it will be a 81 into 0.5, that will be 40.5, 40.5, 81. Therefore, beta will be 162 divided by 81, 2. Do we get the same answer once again now, friends? Please write down till here in your books. Once you're done, chat and let me know that you're done. So I'll go to the next one. Alright friends, now I'll do beta using formula 3. Beta using formula 3. The third formula is standard deviation x divided by standard deviation m into correlation xm. Friends, if you feel I'm going fast, let me know. I will slow down. It is very important that each and every one of you should understand what I'm doing over here. Alright. So I'll now do step by step. Step number 1 will be standard deviation x. X, p, x minus x bar, p into x minus x bar the whole square. Alright. 4, 40, 22, 0.5, 0.5, minus 18, plus 18, 162, 162, 324 is p into x minus x bar the whole square, square root. That will give you the answer as 18. Okay. Step number 2 would be standard deviation of the market. We already got the variance over here as 81. So that will be square root of 81, that is equal to 9. Step number 3 would be correlation of xm. That is nothing but covariance xm divided by standard deviation x, standard deviation m. That will be 162 divided by 9 into 18. So I'll get the answer as plus 1. Correlation plus 1 means maximum risk. Therefore, beta would be standard deviation x divided by standard deviation m into plus 1. You again get the answer as plus 2. Now I'll give you time to write down. Please write down this in your books now. Can I go to the next page now? Alright friends, if you have written down till here in your books, we will go to the next working note now. Working note number 4, beta using formula 4. Friends, this is a new formula which I have not explained earlier. Let me explain this part to you now. What is the logic of the word beta? For every 1% change in the market, what is the change in the security? Am I right? So can I not put this in this manner? This is nothing but change in security divided by change in market. That will give me for every 1% change in the market. Am I right? So this would be nothing but 40 minus 4 divided by 25 minus 7, 36 divided by 18. I again get the answer as 2. So tell me friends, what is the moral of the story? In the exam, if they give you only 2 outcomes, you don't have to do so much of hard work. You can just use a simple formula and you can get the answer. Can you please write down till here in your books now? Alright friends, shall we go and read through the next requirement now? We are done with beta. Now we'll go to the second one. Expected return of aggressive security and the market if the market return is equally likely to be 7% or 25%. So friends, the next working note heading will be expected return. We have already learned that expected return is nothing but sigma outcome into probability. Am I right? So point number A, expected return of aggressive security would be 40 into 0.5 plus 4 into 0.5. That is nothing but 22%. We got this answer as the average earlier. And the expected return of the market will be 16 into 0.5 plus, sorry, not 16, 25 into 0.5 plus 7 into 0.5. That will give you the answer as 16%. Can you write down this in your books now? Hi Komati, the problem with factoring is that that's an exclusive old syllabus topic, and right now we are having a crash of both new and old, so I can't take something which is exclusively to old or exclusively to new. Maybe anyways, with this live session, response and feedback, I'm going to keep a weekly revision, just one day in a week, one quick topic revision. So I will update you on that at that time. If we get time, we'll definitely go and do that. All right. Alright friends, I hope you have put up till here in your books. Yeah. The next part of the question is, they're asking for security market line. Friends, I told you what is the meaning of security market line. Security market line is a graphical representation, but here we'll mention only the equation. That will be RF plus beta into RM minus RF, where beta will be the one which will be kept as variable. So here the equation would be RF will be 7.5 plus, I'll keep beta as such, into RM. RM is equally likely to be 7 or 25, means that is 16, the average, minus 7.5. This equation is what we call it as the SML equation. As beta keeps on changing, the required return will keep on changing. Can you write down till here in your books now? Alright friends, I hope you have put up till here in your books. Now shall we go to the last requirement that is given over here? Alright, they are asking you to find out the alpha. The next working note would be alpha. We learn the formula for alpha. Alpha is equal to expected return minus required return. We got the expected return as 22% in the previous working note. Yes, we got the answer as 22. Minus required return will be 7.5, that is RF. Beta is 2 into 16 minus 7.5. So that will be 22% minus 24.50. So I get the alpha as minus 2.5. Everyone tell me, alpha negative means what? Should I buy or should I sell? I should sell. So I'll write down, since alpha is negative, we should sell the security. Can you please write down till here in your books now? Yes, Aditi, Vipin, you can put it that way. Nothing wrong in that. Alright friends, have you all put up till here in your books now? Okay, shall we now go to the next question? So we are done with this question. Mark these questions as important question friends. We covered 4 formulas of beta, expected return we covered, standard deviation we covered, covariance we covered, correlation we covered, SML we covered, alpha we covered. Everything that we learned in concept, everything comes in one question. So it's a beautiful question. Now let's go to question number 3. Question 2 requires some more concept. Let's do this first, then we will go to the next concept. Alright, I'll give you a minute. Please read through the question, enjoy the beauty of the question, then we will do it together. Alright friends, here they have given returns for 6 years. They have given the return of A. They have given the return of the market. They are asking you to calculate the characteristic line. Okay, so friends, you already know. I'll just give you the answer how to do it, and after that we will do it together. Characteristic line. All right, characteristic line, I told you, is nothing but expected return is equal to alpha plus beta into rm. So here we are going to keep this as a variable one. This would also be variable, but all the remaining pink points will become what? They will become constant. Am I right? So what we have to do right now is we have to go by the following step. Step number one, calculate expected return and also calculate expected return of the market. Step number two, we have to find out the beta. Step number three, we have to find out the alpha. Once we do this, step number four, we can actually work out the characteristic line. Can you please put this approach in your books? Active Ayyappa, it is there in tarunjagdish.com/live, live. Srinidhi, I'll come to your point. I'll explain and clarify your point over here, okay? You have retracted your message, Srinidhi, so I'm assuming that your doubt has been clarified. Alright, friends, have you put up till here in your books? Can I now start solving it one by one? Okay, so I'll write down working note number one, expected return and RM. Okay, so I'll give a heading called as year, expected return of security. This is what I'm calling it as ER, expected return of market, which I call it as RM. Alright. Siddesh, I will share that material in the CA final RPL group also. Yesterday I did not have this admin access, so I immediately put it in my website. Today evening I will share the same material in the RPL group also. Alright. Fine. Now 6 years are there: 12, 15, 11, 2, 10, minus 12. Here it will be 8, 12, 11, minus 4, 9.5, minus 2. Here, since the weights are not given, I will take and do it using simple average. Alright. I get the simple average as 6.33 over here. Here I'll get the answer as 5.75. This will be ER and this is going to be RM. Alright. Siddesh, actually the problem is I'm having two phones. That phone is back at home right now. I'm in office. So I'll get back home in the evening. I will share that material directly to the RPL site by today evening around 5:30. Alright. So from tomorrow it will be easier for you. Right now if you need it immediately, I can just show you tarunjagdish.com. Just enter. There is a button called live. You click on that. The live streaming happening here is happening there also. And below that there is download the material. You click on that and you get the material. Alright. Once you're done, please message and let me know that you're done. Alright friends, once you are done with this, we will now go to step number 2, beta. Beta. Friends, since probability is not given, the first method is the best method of finding out beta. You can use any of the methods, you'll get the same answer. Alright. I'm using the first method because that's easier for me. 12, 15, 11, 2, 10, minus 2, 6.33, 8, 12, 11, minus 4, 9.5, minus 2, 5.75. Okay. Here it will be 96, 180, 121, minus 8, 95, 4. I'll get the answer as 488. Here it will be 64, 144, 121, 16, 90.25. Friends, to find the square, you just have to do 9.5 into equal to. You will directly get the answer. You don't have to do 9.5 into 9.5. I hope you are aware of such shortcut techniques also. So I'll get the answer as 439.25. So the formula would be 488 minus 6 into 6.33 into 5.75 divided by 439.25 minus 6 into 5.75 into 5.75. $269.615. 240.875. So the answer what I will get over here would be 1.12. This is the final answer. Can you please write down till here in your books? Did I make a mistake somewhere? Is it minus 12 for the last one? Oh God, I have taken minus 2. So my answer must have got messed up. 1 minute friends. So this will become minus 24 and it will become plus 24, right? So let me just check. 96 plus 180 plus 121 minus 8 plus 95 plus 24 will give me this number as 508. So this instead of this will become 508. $289.6 divided by 240.875, it will be 1.20. Sorry for the inconvenience friends, can you please correct it accordingly? Alright. Once you're done, please message and let me know that you're done. Okay. Kavita is done. Siddesh is done. Okay. Fine friends, can I now go to the next part? Once I find out beta, now I'll write down working note number 3. I will have to find out what now? Alpha. What is the formula for alpha? Expected return minus required return. Am I right? So friends, expected return we got the answer as 6.33. Required return is normally what? CAPM return, that is RF plus beta into RM minus RF. Alright. But friends, in this question, have they provided any RF? RF is not provided. So in the absence of RF not being provided, we will use beta into RM as the required return. So we can give a note over here. In the absence of RF, required return is found using beta into RM. So the formula would be 6.33 minus 1.202 into 5.75. Okay. Minus 6.33. I'll get the alpha as minus 0.58. Now tell me, alpha positive or negative? Negative. Since alpha is negative, we should buy or we should sell? We should sell. Can you please write down till here in your books, friends? Rangesh, please do that. Material has to be spread out to everyone. If you can, do you have the access to, putting the drive link here? You mean in YouTube or in the Telegram channel? Put it wherever you want. Doesn't make any difference to me. Let it be shared with everyone. Alright friends, so we got the answer. Now I'll go to working note number 4, where I will write down characteristic line. Okay, characteristic line will be ER, which is variable, is equal to alpha. What is the alpha? We got minus 0.58 plus 1.202 into RM. So this is going to be kept as variable. This will also be kept as variable. And the remaining things will be kept as constant. Can you please write down till here in your books now? So Siddesh, are you from Tamil Nadu? Alright friends, I hope you have all put up till here in your books now. Okay, so we are done with this part of the question. We have got the characteristic line. Wait, let everyone reply and tell me that you are done, then only I'll proceed. I don't want to speed. Okay, Chitra is done. Excellent. Okay, so I think many are done. I'm going to the next requirement now. The next requirement is systematic risk and unsystematic risk. So I'll just write down the next working note heading, working note number 5, systematic and unsystematic risk. Friends, like I did before, I'll draw a chart and make it very clear to you. We are having total risk. Inside this, we are having two parts: diversifiable risk, non-diversifiable risk. This will be nothing but standard deviation of the security. Security over here is nothing but A. Alright. This will be non-diversifiable risk of A will be beta of A into standard deviation of the market. We learned this formula in the morning. This will be nothing but dr of A will be total risk of A the whole square minus non-diversifiable risk of A the whole square root. Can you please put this chart in your book so that you are fully clear? Alright, so Siddesh, you know Rangesh is from Tamil Nadu and that's why you called him Talaivar. Good, yeah. How do you know each other so well? You're both friends, or from YouTube you got to know each other? Because from here I can only see your names and I wouldn't even know where are you from actually. AJ, where is the link for notes? I'm not able to view it in my phone. Alright friends, let's get back over here. So have you put up till here in your books? So let's do it one by one. I'll write down step number 1, total risk of A. So I'll draw the table A, P. Friends, here probability is not given, so I will not put P. Instead, I'll put A minus A bar. A minus A bar the whole square. Whatever answer I get, I will divide that answer by 6. So basically, I will take simple average over here. That's all. So let's put the numbers over here, friends. Alright. So the numbers would be 12, 15, 11, 2, 10, minus 12. Okay. And we got the A bar as 6.33. Now friends, there is a shortcut technique in the calculator that you can use for getting A minus A bar. In your calculator, you can do 12 minus 6.33 equal to, I got 5.67. Next one, you don't have to do 15 minus 6.33. You just do 15 equal to, you will get the answer. Then you do 11 equal to, you will get the answer. Then you do 2 equal to, and so on. I don't know if all calculators work like that. My calculator, which is a Casio, works in that manner, and I think all Casio calculators work like that. Okay. So A minus A bar the whole square would be 32.14, 75.16, 21.81, 18.74, 3.67, that is 13.46, 335.99. So I'll get the number as 497 something. Once I divide it by 6, I'll get the answer as 82.88 will be the variance. Square root of this will be 9.10. This is going to be the standard deviation. Can you please write down till here in your books, friends? Thank you, MM Kurvila. Whatever tips I'm having, I'll share everything. There are some lessons also which I've learned from my life and from many successful personalities. I'll be sharing a few lessons, 5 minutes every day from today onwards. Okay. Are you done with this? Please message and let me know that you are done. Bilal, we are dividing by 6 because normally we do P into A minus A bar the whole square. So we multiply with probability, we take the weighted average. Here probability is not given, so we are taking simple average by dividing by 6. Alright, friends, you are done with this. Okay, once we get this, step number 2 will be what now? It will be non-diversifiable risk of A. That is nothing but beta of A into standard deviation of the market. So 1.202 into standard deviation of the market. So let me take a fresh page to find out standard deviation of the market. M minus M bar the whole square. 8, 12, 11, minus 4, 9.5, minus 2, 5.75. 2.25, 6.25, 5.25, minus 9.75, 3.75, minus 7.75. Alright, so 5.0625, 39.0625, 27.5625, 95.06, 14.06, 60.06. The total will be 240.86 divided by 6 will give you 40.14. Square root of this will give you 6.33 as the standard deviation of the market. Can you please write down till here in your books now? Alright friends, are you done with this part also? Okay, so we got standard deviation of the market. So I come back over here now. 1.202 into 6.33. I'll get the answer as 7.61 as the non-diversifiable risk. Can you write down till here in your books now? Alright friends, I hope you have put up till here in your books now. Yeah. So once we get non-diversifiable risk, the last step number 3 will be what now? Diversifiable risk of A. Diversifiable risk will be nothing but total risk of A minus NDR of A, the whole square root. So the total risk turns out to be 9.1 square. NDR is 7.61 square, the whole square root. 82.81 minus 57.91, the whole square. I'll get the number as 25 approximately, the square root of which turns out to be 5. Can you please write down till here in your books now? Yes, Aditi, your answer is right. Alright friends, everybody is clear with this? So with this, I believe we are done with this question also. Am I right? Okay. Just chat and let me know that you are done so we can go to the next concept. Excellent. If you're done with this, go back to your concept parts and write down the next concept heading, overall beta and proxy beta. Siddesh, you can do rounding off. There is no issues in that. All right. I'll give you a very simple example for overall beta now. Let us assume I'm talking about Reliance. Okay. If you check the Reliance balance sheet, it will have liabilities. Let's say they will have some rupees, and here they will have what? Assets. Assume that they are only having two types of assets. One is petrol and the other one is geo. And here they are having both equity as well as liability. What is the logic of the word beta? For every 1% change in the market, what is the change happening in the security? So can I say petrol will be separately listed, so I can find out the separate beta for petrol? Geo will be separately listed as a share, I can get a separate beta for Geo. Let us say the beta of petrol is 3 and beta of Geo is 1. Let us say, for example, and let's assume that Reliance has invested 0.5 in petrol and 0.5 in Geo. From this, I can actually find out the weighted average. That is, I will get 1.5 here. I'll get 0.5 over here. I'll get the overall answer as how much now? 2. Okay. This fund must be pumped either by way of equity or by way of debt. Alright. So we can actually call this as beta overall, because this is the overall beta of both petrol and Geo. Friend, normally the balance sheet always tallies. So here also on the liability side, the beta overall will turn out to be 2. Okay. Here also I'll put beta weight, beta into weight. Now, liability means we're talking about debt. Friends, what is the logic of the word beta? Let me repeat once again. For every 1% change in the market, what is the change happening in the security? Now tell me, when market changes, will there be any change in the debt? No, debt will remain the same because there is a guaranteed return. It is something like a stable person that we spoke in the earlier example. So beta of debt is normally turning out to be 0. Assume the weights are 0.5, 0.5. Here I will get the answer as 0. Once I get this answer as 0, then this will be the balancing figure, which will turn out to be 2. If this is 2, I do a backward working. Here I get the answer as 4. 4 is what I call it as beta equity. 0 is what I call it as beta debt. This is called beta of petrol. This is called beta of Geo. Or the logic goes like this. Petrol has a beta of 3 or risk of 3. Geo has a risk of 1. Both together you have a risk of 2. Overall risk is 2, but debt holders will not take any risk. They want the repayment back, hence the risk becomes 0. The whole tension has to be suffered by the equity holders. That is why their BP goes up and their beta value goes up to 4 rather than standing at 1 or 2. Can you draw this picture in your books now? Yes, Shivan, let everyone finish it. Alright friends, if you have put up till here, we can create a new formula out of this. The formula will go like this. Can I say beta of petrol into weight of petrol plus beta of Geo into weight of Geo is equal to beta overall. Okay. Similarly, can I also say beta overall is equal to beta equity into weight of equity? plus beta of debt into weight of debt. Can you put this equation in your books now? Alright friends, have you all put up till here in your books now? Okay. In this case, we have learned one equation. Now I will do a modified equation. Give a heading in your books called as modified equation. Okay. Here I'll write down. We learned that beta equity into weight of equity plus beta of debt into weight of debt is equal to beta overall, right? I can also mention this as beta equity into E divided by E plus D plus beta of debt into D divided by E plus D is also beta overall. That's basically the weights. Now friends, here there is a small twist. I don't fully agree with the coming formula, but it's a part of your syllabus. You have to learn it. Friends, whenever I take a loan, I pay interest on that. On this interest, I have something called as tax benefit. That is why we do something called as 1 minus tax rate. Am I right? So here what I'll do is I'll put the equation like this. Beta equity into E divided by E plus DE into 1 minus tax rate plus beta of debt into D into 1 minus tax divided by E plus D into 1 minus tax will give you the beta overall. First you write down this and you tell me, do you agree with this formula or do you find there are some concerns in this formula? Tell me friends, do you find any concern with this formula? Alright friends, I will tell you one issue with this formula is this 1 minus tax. Friends, this 1 minus tax normally comes on what? Does it come on the debt portion or does it come on the interest portion? It comes on the interest portion. But when this formula is created, it is actually put as a part of the debt portion only. That is the one thing which is not fully considered and which is not fully, I'm not fully okay with it, but it's a part of your syllabus. So we learn it this way. They have their arguments. I'm not going in depth of it, but this is something what I cannot fully agree. And friends, SFM has got so many formulas. Each formula is an opinion. Everyone can differ on their opinions also. Okay, Sai Reddy, you said it right. Kavita, your doubt is good. When the beta of debt will be 0, then there is no significance of the second part. Kavita, this has got a significance. I'll give you a simple example. You remember a case of IL and FS which happened? It was a debt company. Alright? This company did not repay the loan. The moment this company didn't repay the loan, the share market also crashed. And what happened? For every 1% change in the market, even this company fell down. So such cases, when the debt repayment doesn't happen, there will be a beta for debt also. Hence, this equation comes like this. But exam point of view, beta of debt will 99% cases be only 0. Shubham, the systematic risk, etc. I already explained earlier. I went very slow also. I request you to replay the video later on rather than me going back and explaining it because that will consume some time. Please write down till here. Have you all put up till here in your books, friends? Now you give the next heading in your books called as Proxy Beta. Alright friends, let me ask you one question. Assume RPL, that is Revision Premier League, was a coaching center. For timing, let us assume it this way, that Revision Premier League is a coaching center which is running its operation across India. It's having its operations in Kerala, Karnataka, Andhra, Maharashtra, Delhi, everywhere. Assume that way. RPL is a private company. I'll put it this way. RPL is a private company. I want to find out the beta of RPL. Which formula will I use to check the beta of RPL? Formula 1, Formula 2 or Formula 3? Can you please interact and tell me the answer? I think the chat is taking some time to come. Friends, whatever answer you gave, I'll tell you, you can't use Formula 1 also, can't use Formula 2 also, can't use Formula 3 also because RPL is a private company. It is an unlisted company. If you want to find out the beta for RPL, you can find out beta only for a listed company because the logic of the beta is 1% change in the security for every 1%, sorry, how much is the change in the security for every 1% change in the market? Am I right? So RPL is unlisted. I cannot find the beta of RPL using any of the formula. The only one thing what RPL can do now is RPL can check the proxy beta. Proxy beta means what RPL will have to do is RPL will have to take any CA coaching which is already listed in the share market. From that they can find out the beta of that company. For timing, let's assume MT Educare, Mahesh Tutorials is a company which is listed in the share market. I don't know right now what is the status of MT Educare. It's like Chennai MT Educare has been closed down. Many places JK Shah has taken over is what I'm hearing. For timing, let's assume nothing of that sort has happened. And MT Educare is a listed in the share market and doing its operations freely. Okay. MT Educare and RPL both being coaching centers will have the same risk. If they have the same risk, I can say that beta overall of MT Educare and beta overall of RPL will remain the same because they have the same risk. For example, if the institute decides that the pass percentage for CA intermediate students will be 0%, nobody will reach final. Neither will FT Educare get any students for final, neither will RPL get any students for final. I'm giving an example. Alright. So what RPL will have to do to find its beta is it will have to go by 4 steps. Okay. Step number 1 would be it will take the beta equity of FT Educare. This can be found out directly from the newspaper. Newspaper only provides beta equity. Newspaper does not provide overall beta. From the beta equity of MT Educare, we can find out the beta overall of MT Educare. Then we can say that since MT and RPL are falling in the same risk class, beta overall of MT will be equal to beta overall of RPL. Once I get this, I can go to step number 4 and I can find out beta equity of RPL. Can you please write down this in your books now? Yes, Siddesh, you gave the right answer. Ashwini, you have told the right answer. Logana, then why we can't use total risk is equal to NDR minus DR? I already explained in detail. Please go back, play the video. The whole logic is explained over there. Okay. Well, Manikam, I'm not very sure about what's happening with MT Educare, but all the faculties have moved out. That's the final news that has come out. Yeah. So friends, these are the 4 steps using which I can find out the beta of any company anywhere. Just need a proxy company which is there in the share market. Everybody clear? So the 4 steps are beta equity of MT Educare, beta overall of MT Educare, beta overall of MT will be beta overall of RPL. That will give you beta equity of RPL. Friends, once you do a question, this will become 100% clear to you. Once you have written down till here, please let me know that you are done with this so that we can go to the next question. Alright friends, I hope you are done with this. Now, I'll give you a minute's time. Read through this question. Try understanding the question and just try solving it. In a minute's time, I'll start solving this problem. Question number 2, which is a question on proxy beta. Can you please go through this on your own, friends? Alright friends, shall we start solving it together now? Okay. I'll go through the 4 steps. Step number 1. Here they have given 2 companies, one is alpha and the other one is gamma. Okay. They have given the details of alpha from which they need us to find out the equity beta of gamma. So I'll go by the 4 steps. Step number 1 will be equity beta of alpha, which is already given in the question as how much? 1.3. Step number 2 would be beta overall of alpha. Okay. For this I'll use the formula beta overall is equal to beta equity, that is 1.3 into E divided by E plus D. So the debt equity ratio of alpha is how much? Is it turning out to be 1:4? So 1 is debt, 4 is equity. 4 divided by 4 plus 1 into 1 minus 40%. Alright. Plus they have told debt is risk free. So when debt is risk free means what? Beta will be 0. I'll put 0, rest of the things I don't have to do. So my answer would be 1.3 into 4 divided by 4.6. I will get the answer as 1.13. Once I get this, I will write down step number 3. Beta overall of alpha is equal to beta overall of gamma, which is equal to 1.13. Alright. Once I get this, I'll go to the final step, that is step number 4, where I will find out the equity beta of gamma, for which I'll use the equation beta overall is how much? 1.13. Am I right? 1.13 is equal to beta equity of gamma, into what is the debt equity ratio of gamma? Let's check now. That is 2:3. 2 debt, 3 equity. So it will be 3 divided by 3 plus 2 into 60%. 1 minus tax rate. That's 3, 4.2. So it will be 1.13 into 4.2 divided by 3. We will get the answer as 1.582. This is the beta equity of gamma. Alright friends, can you please write down till here in your books now? Yes, that's the right answer. Alright friends, can you write down this also in your books now? Once you are done, please write and let me know that you are done. Alright, Chitra is done, Siddhesh is done, let everyone finish. Excellent. Okay. So everyone is done with this. Have you got the answer as 1.58 over here? Excellent. So once you are done with this, we are done with this question on proxy beta also. Let's quickly go to the next concept. Arbitrage pricing theory model. Everyone write down the next heading. Arbitrage pricing theory model. Friends, let me explain to you. This formula has come only because of ego problem. What is the formula for CAPM? RF plus beta into RM minus RF. Am I right? Friends, I will just write it down like beta XM into RM minus RF. What do you mean by beta XM? Which means for every 1% change in the market, what is the change happening in the security? That's all. Okay. This formula got the Nobel Prize. So just imagine the anger that the other fellows must have thought. This simple formula got a Nobel Prize. I am sitting here working very hard day and night doing all the things. We never get any Nobel Prize. This fellow made a one-liner formula and this fellow has got the Nobel Prize. Now people started criticizing the CAPM formula. They said this formula is wrong. They said that we are taking only beta XM. XM means what? For every 1% change in the market, what is the change happening in the security? But market is only one factor of non-diversifiable risk. Market is fully diversified, hence its diversifiable risk becomes what? Zero. But there are many other non-diversifiable factors also. For example, GDP. inflation, etc. So they say that the formula should be required return is equal to RF plus beta XM into RM minus RF. We should not stop with this, plus beta XI. What is this I? Inflation into RM of inflation minus RF plus beta X GDP. That is for every 1% change in GDP, what is the change happening in the security, into RM of GDP minus RF plus beta X Forex. That is for every 1% change in Forex, what is the change happening in the security, into RM of Forex minus RF, and the formula goes on. Now once this formula was created, this great guy thought, I will get the Nobel Prize. Tell me, my dear friends, did he get the Nobel Prize for this? No, never. But this formula came in our syllabus. Can you please write down this in your books now? Alright friends, once you're done with this, shall we do a problem on this one now? Alright. Can you please read through this question and try doing this question on your own? Just read, understand the question first. There are basically 4 shares. One guy called Nirmal is there. This table and the below required data is relevant. Just read through it, understand the question, try solving it here and there. You will get a grip, after which I will solve it along with you. Okay, your 2 minutes starts now. Friends, just a minute. One person has come to check the Wi-Fi and the speed of the Wi-Fi. So I'm just disconnecting from the office Wi-Fi and reconnecting on the mobile hotspot. 1 second, the video might get stuck. Please cooperate with me for 1 minute. All right. Alright friends, I'll start solving the problem. It might get stuck a little bit, then it will come back. I'm also checking in my phone, so I'll get to know when it's getting hanged. Alright? Okay. Now this question, for finding out using arbitrage pricing model, they have given three factors: beta, book price, and the last one they have given as inflation. Alright? So here I'll just write down like this. I'll draw a table. Particulars, computation. Okay? Small cap growth, I'll call it as SCG, and the computation will be RF plus, how much is RF? 4.5 plus beta is 0.80 into 6.85 plus 1.39 into minus 3.5 plus 1.35 into 0.65. Alright, so the answer what I get over here will be you'll get the answer as 5.99. This is the return. Here is the weight. So I just have to do return into weight. The weights are given as how much? 25%. You'll get the answer as 1.50 percentage. Friends, like this, can you do the remaining on your own? In the meanwhile, the Wi-Fi will also get corrected. The second one will be small cap value, large cap growth, large cap value. Same model, you have to do it. Can you please do this on your own, friends? Please reply and let me know. If you can't do it, I will do the whole thing on the board again. Second one will be small cap value, large cap growth, large cap value. Same model, you have to do it. Can you please do this on your own, friends? Please reply and let me know. If you can't do it, I will do the whole thing on the board again. Siddesh, the risk premium basically means RP minus RM minus RF. Correct. So that is RF is already reduced. In this question, for example, if they have given 6.85, that is already RM minus RF. So if you reduce again RF, that will be double reduction. Ashwini Ayyappan, this is question number 4. Okay. Question number 4 in the handout, portfolio management chapter. I need to check. 7.75 I think is the answer. I don't exactly remember the answer. We'll check and do that. You want me to flash the question? Alright, I'll flash the question in that case. This is the question. Okay. So the answer is 7.75. Everyone please do it in this manner. And if you have any doubts, let me know. SCV is small cap value. You got 8.85, is it? What is 10 minus 0.88? I didn't understand. Okay. Alright, 10% is the weight, is it? Alright. Yes, 7.75 is the answer. I'll give the final answer on the board. Badri Narayan, please give me for the remaining also. Okay. I'll just write down by coming over here. So the second one you got the number as 8.85 here. 10 percentage, that is 0.88. Third one you got 8.47. 50 percentage, so you get 4.23. So last one is 7.54 and the weight is 15 percentage, that is 1.13. If you add up all these things, you will get the answer approximately as 7.75. Everyone, can you please update this in your books? Once everyone is done, please let me know by chatting that you are done. Alright, Shweta is done. Prabhurajan is done. Alright. Can I go to the next page now? Okay. So friends, the next part of the question is use CAPM to get the same answer. To get not the same answer, to get the answer. So the next working note heading will be solution using CAPM. Alright. Here I'll draw a table. It will be much easier over here. Particulars, computation, return, weight, return into weight. Alright. Again, I'll show you the first one. Rest you have to do it on your own. Okay. The first one is small crab growth, SCG. Listen very carefully first. Then I'll show you the question only. You have to solve it. You're looking at the question. So please copy down this format in your books. It will be RF plus 4.5 plus beta. Beta is 0.8 into RM minus RF. So that is 6.85. That's it. Nothing else is required. The return will be 9.98 percentage. The weight for the first one is 25 percentage. I'll get the answer as 2.495. Like this, can you do the remaining on your own, friends, now? I'll give you a minute, copy down this, then I will show you the question so you can solve it on your own. Yes, I'm going to the question. Please do it on your own. Alright friends, can I just put up the answers, whatever you are telling me one by one? Overall the answer is 11.35. Can you please tell me the breakup, like how much is SCV, how much is large cap growth, and how much is large cap value? Sanjay, whichever is the question, can you please share in my WhatsApp? I need to check that and then we will do it if we get time. We are running short of time actually. I need to still do international finance, options, and then interest rate derivatives, mergers. Huge load is there. Then you share it with me, otherwise it will come in my website. Okay. Alright, I think everybody has got the answer as 11.35 now. Once you're done, just let me know that you are done. Fine. I believe CAPM is something what everybody has got. Have you all got the answer as 11.35? Alright friends. In case you are done with this one, shall I now go to the next one now? Okay. The next requirement, the last one is a very good requirement. Please read through this requirement. Nirmal wants to construct a portfolio constituting of only the small cap value and large cap growth. Okay. Next working note heading will be portfolio for Nirmal. Okay. Particulars. He only needs small cap value and he needs large cap growth and he wants his desired overall beta to be 1. Let us check the beta of small cap value. It's 0.9. What is the beta of large cap growth? 1.165. Let us take the weights as x, 1 minus x. From this we can find out beta into weight, 0.90x, 1.165 minus 1.165x. He wants the overall beta to be 1. So the equation would be 0.90x plus 1.165 minus 1.165x is equal to 1. Alright. So what I have to do is I'll have to take it on the other side. So here I'll get 0.165 is equal to 0.265x. Therefore, x is equal to 62.26%. This much should be the weight of small cap value and the balance should be the weight of large cap growth. Can you write down this in your books now? Alright friends, have you all put up till here in your books? Okay, so you have got the answer as 62.26%. With this friends, we are done with this question also. Shall we now go to the next concept? Everyone write down the next concept heading. Arbitrage pricing theory model formula 2. One formula was not enough friends. One more formula is coming on your way. Friends, CAPM got the Nobel Prize because of ego problem. First fellow came. He came and told CAPM is wrong. He made a big formula that did not get the Nobel Prize. That is when the second fellow came. Second fellow told CAPM is not right. Arbitrage pricing formula 1 is also not correct. This should be the correct formula. And he made this new wonderful formula where required return is equal to RF plus beta XM into, instead of putting RM minus RF, he put actual value of market minus expected value of market plus beta xi. I is what? For every 1% change in inflation, what is the change in the security, into actual value of inflation minus expected value of inflation plus beta x GDP into actual value of GDP minus expected value of GDP, and so on. This fellow thought he will get the Nobel Prize. My dear friends, tell me, will he get a Nobel Prize? No, never. But this formula also came in your syllabus. Please write down in your books, friends. Once you're done writing, please let me know. Alright friends, shall we go to the next question now? Okay. This is the next question on arbitrage pricing model. I'll give you 2 minutes, read through the question, enjoy the beauty of this question, after which we will do it together. Siddesh, you have a very good point. You can buy securities from BSE and sell in NSE, but understand these two are two separate markets. So let's say, for example, you are buying in BSE. Later on, to cancel that, you have to sell in BSE only. You can't take, let's say, a Reliance share from BSE, go to NSE and sell it to them. These two are two separate tradable markets. Are you getting my point? But yes, in futures, people make money like that. They trade in futures, they'll sell here, buy there. The net difference will be the profit what they will make over there. I'll be explaining that once I do futures. Alright friends, have you gone through this question now? This question we need to find out the return using arbitrage pricing model. It's a very simple thing. Friends, I will do this in Excel so that I can get the answer faster. The formula is very simple. Here everything is given, expected value, actual value, everything is given. I'll just take an MS Excel. I'll paste these numbers over here. Okay. Yes. Only one rearrangement what I will require over here will be actual value comes first and then should come expected value. That is the only one way how they have tried to confuse you. I'll increase the font also. Let me first put up everything. So return will be, in simple terms, whatever is the beta into actual value minus expected value. Alright, let me convert this into percentage. Oh, sorry friends, 1 minute. Okay, here the answer would be 0 because nothing is coming over there. It's 7.7, 7.7. Let me remove the percentage sign, make it in numbers, and the sum total of this will turn out to be, sorry, I need to remove number from here also. Remove percentage from here also. Add RF. How much is RF that is mentioned in the question? 9.5. 25. So my return will be this plus this, that is equal to 17.4. I'll increase the font now. I will increase the size also. Alright friends, can you see this board and can you write it down on your own now? Yes, the answer is 17.41%. Once you're done writing, please let me know, okay? Alright friends, have you put up till here in your books? Fine friends, we are done with this concept also. Shall we go to the next important concept of this chapter now? Okay. We are done with this. I think this is the final concept that I need to cover now for portfolio. New formula for covariance. I'll first give you the formula and then I will explain to you how this formula was derived. Covariance xy is equal to beta x into beta y into variance of the market. Can you write down till here in your books? Vandan and S. Kumar, I didn't understand. What formula are you asking? Alright friends, have you put up till here in your books? I will now tell you how this formula actually came into existence. This formula was created by a jobless statistician. He had no other work. Sitting at home, he was getting bored. At that time, there was no Facebook, Instagram, WhatsApp, Telegram, etc. No YouTube Live also was not there. So this guy was sitting at home and just playing with numbers. Alright. So what he actually did was he first put a table called as covariance. Let us say the table is x, y, p, x minus x bar, y minus y bar, p into x minus x bar into y minus y bar. Assume the numbers are 10, 20, average is 15. This is also, let us say, I'll take it as 20, 40 and the average will be how much? 30. 0.5, 0.5, minus 5, plus 5, minus 10, plus 10, so it will be 50 into 0.5, 25, 25, 50. He got this answer. By just getting this answer, he should have actually kept quiet. But this fellow was getting very bored at home, had nothing else to do. Then he decided that he will find the variance of the market. Now let's say the market was turning out to be 10 and 20, exactly the same as x. 15, 0.5, 0.5, okay. M minus M bar will be minus 5 plus 5. P into M minus M bar the whole square will be 25 into 0.5 will be 12.5. 12.5 will get the total as how much? 25. Now this fellow got the variance of the market also. He got the covariance of x and y also. Still he was getting bored. So he decided that he will find out the beta of x using the shortcut formula. That is change in security divided by change in the market. Alright. So the change in the security for X will be 20 minus 10 divided by 20 minus 10. Do you get the answer as 1? He got the beta of X as 1. Still he was getting bored. He found out beta of Y. Beta of Y will be 40 minus 20 divided by 20 minus 10. So he got the answer as 20 divided by 10. He got the beta as 2. Still he didn't keep quiet. This fellow simply went and multiplied. He did variance of the market is how much? 25 into 1 beta of X into 2 beta of Y. He got the answer as 50. Then he cross-checked this answer with the previous table. And then he saw the same answer has come over here. Eureka! He has derived a new formula. And the new formula has been derived like this, and now it's there in your syllabus. That is nothing but variance of the market into beta X into beta of Y will give you covariance of XY. Can you please write down this in your books now? Start from here. Can you write down this now? Shubham, I didn't understand. 0.8, 1.14. Is this the answer for the next question that you're doing? Okay. Are you done with this? Shall we start with the next question now based on this? Alright. Everyone take this question. I'll give you a minute. Read through the question. Enjoy the beauty of this question. Alright, in this question we are having three securities A, B and C. They have given the standard deviation, they have given the correlation with index. Very important. They have given correlation AM, that is A with index. They have given correlation BM. They have given correlation CM also. Given. They have not given correlation AB. They have not given correlation BC They have not given correlation AC. Not given. Can you please put this in your books? I'll just get some water and get back. Shubham, your answer is right. Okay, fine. Now let's do this together. First requirement is, what is the sensitivity of the return of each stock with respect to the market? So they are basically asking you to find out the beta. I'll just show you how to find out beta. Working note number 1 would be beta, particulars, formula, computation, result. Okay, so beta of A, the formula will be standard deviation A divided by standard deviation M into correlation AM. Beta B, the formula will be standard deviation B, standard deviation M, correlation BM. Beta of C will be standard deviation C, standard deviation M, correlation of CM. Can you do it like this on your own now? Numbers would be 20 by 15 into 0.6. Second one would be 18 by 15 into 0.95. 12 by 15 into 0.75. Please do this on your own, friends. 0.8. 1.14. Oh, I think the last one I made some mistake. Is it 12 by 15 into 0.75? 2.5. Is that the answer for the last one? Should be 0.6. There's some mistake. 12 by 15 into 0.75. Yes, it's 0.6. Can you please write down till here in your books? Alright, friends. Have you all put up till here in your books? Alright. Can I go to the next one now? The second requirement is find out the covariance among the stocks. Working note number 2. Covariance. I will draw a table now. Particulars, formula, computation, result. Covariance AB, covariance BC, covariance AC. Beta of A, beta of B variance of the market, beta of B, beta of C variance of the market, beta of A, beta of C variance of the market. Alright. So the computation part, it will be beta of A is how much? 0.8, 1.14 into 225, 0.6 into 225, 225. Okay, the answer is 205.2. 153.9, 108. Please do this, friends. Alright, friends. Have you all put up till here in your books? Once you're done, please let me know. Alright, friends, are you all done with this? Okay. Now we'll go to the next one. Next one is a beautiful question. What would be the risk of the portfolio consisting of all the securities together? Okay. They are asking you to find out the combined risk. Friends, combined risk we can find out either using Markowitz method or matrix method. Here I will find this out using both. Let us start with Markowitz method. Alright. What I'll do is I'll break up the formula. Okay, the formula I will put it in this manner. Here it is 3 securities, A plus B plus C the whole square. That is A square plus B square plus C square plus 2AB plus 2BC plus 2AC. Alright. So the formula would go like this. I'll give a heading called formula computation result. So first one would be standard deviation of A, weight of A the whole square. Standard deviation B, weight of B the whole square. Standard deviation C, weight of C the whole square. 2 into standard deviation A, standard deviation B, weight of A, weight of B, correlation AB. Now tell me, correlation AB, is it available in the question? No. So instead I will use covariance AB divided by this into this. So this will get cancelled. So the new formula will be 2 covariance AB into weight of A, weight of B. Formula computation result. After D you are having E, that will be 2 into weight of B, weight of C, covariance BC. F will be 2 into weight of A, weight of C, covariance of AC. So let's do this together now. So here it will be standard deviation A 20 into 1 by 3 the whole square, 18 into 1 by 3 the whole square, 12 into 1 by 3 the whole square. Here it will be 2 into 1 by 3 into 1 by 3 into covariance AB we found out here 205.2. Okay. Next one 2 into 1 by 3 into 1 by 3 into covariance BC is 153.9. 2 into 1 by 3 into 1 by 3 into 108. So my answers will now be 44.44, 36, 16, 45.6, 34.2, 24. 200.24, the square root will be 14.14. Can you please write down on your own, friends? Once you're done, you let me know that you're done. Kirtana, can you hear me now? Wait, let me cross check. You want me to refresh?
Kirtana, can you hear me now? Wait, let me cross check.
Oh, so you're saying Kirtana to refresh, is it? Okay. Alright, so everyone is done with this. Write down this also. Manikam Gopinath, this is the last problem. With this, we are done with portfolio. We have covered almost all the concepts, and with just 6 questions, we have covered almost all the questions also. There are a few left. I'm not telling it's 100%, but yes, 80% is done with this. Alright, friends, once you're done with this, Manikam Gopinath will start with mergers also today. Business valuation we'll try doing. Okay. So the next working note heading will be combined risk using matrix method. Here what we do, we draw the matrix, covariance and then combined risk A, B, C, 1 by 3, 1 by 3, 1 by 3, A, B, C, 1 by 3, 1 by 3, 1 by 3. Alright. So as I mentioned earlier, AA is variance of A, AB is covariance AB, AC is covariance AC, etc. So AA will be 400, that is 20 square. BB will be 18 square, that is 324. CC will be 12 square, 144. Covariance AB will be 205.2. Covariance AC will be 108. And covariance of BC will be 153.9. Can you please write down till here? Then I'll go to the next page and show you how to do the remaining. Gauri Shankar, that was also a part of the syllabus as to what proportion to be used. I'll explain the formula to you. Based on the formula, you can go and do the problem. So I'll explain that concept after this. Alright? Alright friends, I hope you have all put up till here in your books. Okay, let me go to the next part now. I'll now find out the combined risk. We'll put a table like this, particulars, computation, result. We'll have AA, AB, AC, BA, BB, BC, CA, CB, CC. AA will be 1 by 3 into 1 by 3 into 400. AB will be 1 by 3 into 1 by 3 into what is covariance AB? Is that 205.2? This is 1 by 3 into 1 by 3 into AC is 108. So BAAB will be the same. I'll just do 205.2 divided by 9. Okay. I hope you are understood why I am dividing by 9. BB will be 324 divided by 9. Okay. BC will be 153.9 divided by 9. CA will be 108 divided by 9. CB will be 153.9 divided by 9, and CC will be 144 divided by 9. So the answer what I'll start getting will be, check, you can do 1 by 9, you will get 0.11111 into 400, that will give you 44.44, 205.2, 22.80, 108, that will give you 12, 205.2, that is 22.8, 324 is 36, 17.10, 12, 17.10, 16. That will give you 200.24. The square root will be 14.14. Friends, is this not the same answer that we got earlier also? Excellent. Can you please write down this in your books and finish it off? Badrinaran, you can do 0.33, nothing wrong. However you do it, it's the same thing. All right, let everyone finish. All right, friends, I hope you are all done with this now. Okay, shall we now go to the next part of the question? Next, they are asking beta of the portfolio consisting of equal investments in each stock. So the next working note, what they are asking is, they are asking for the overall beta. That is very simple. Beta of A into weight of A plus beta of B into weight of B plus beta of C into weight of C. So here the answer would be, what are the betas? 0.8, 1.14 and 0.6 into 1 by 3 plus this into 1 by 3 plus this into 1 by 3. I'll be getting 0.266 plus 0.38 plus 0.2. So the answer would be 0.85 or 846. Can you please write down this also in your books? Total risk is separate and variance is separate. Komati or C. Kumar, So we would prefer taking the variance and taking a square root so we get the right answer. Yes, Ruchi, your answer is right. Alright friends, have you all put up till here in your books? So let's go to the next question now. Beautiful. Now they are asking total risk, systematic risk, unsystematic risk. So one question which covers everything. So let me write down the next working note. Total diversifiable risk and non-diversifiable risk. I use diversifiable and non-diversifiable because that's easier to do. Alright. I'll put one by one. Point number A would be total risk. Have you already got the answer as 14.14? 2 will be non-diversifiable risk of X, not X now, it is a portfolio. We are having 3 securities, right? Will be beta of portfolio into standard deviation of the market. So 0.846 into 15. I'll get the answer as 12.69. Point number C, diversifiable risk of portfolio will be total risk square minus non-diversifiable risk square, the whole square root. That will be 200 point something, 161.03, the whole square root. I'll get the answer approximately as 6.24%. Can you write down this also and finish it off? Alright friends, are you done with this? Okay. Have you all got the answer as 6.24? Alright friends, so we are done with this question also, and ideally speaking with this we are done with the overall part of portfolio management. One part which one student has asked, he wants to know how to compute minimum risk portfolio. Let us learn that also quickly. How to compute minimum risk portfolio. Alright, can you write down this heading in your books now? Friends, I'll take an example and I will show you how to do this. Suppose standard deviation of X is turning out to be 10%. Standard deviation of Y is also, let us assume it is 10%. 1 minute, there's a doubt. Yes, MM Kurvila. Yeah, that's what I told you. You cannot add risk. You can only add or subtract variances. That is why 12.69 and 6.24 cannot be added right away. Only the squares of these can be added and then you can take a square root. Alright. Variance can only be added. Risk cannot be added. I'll get back to this example. Standard deviation of x is given, of y is given. Suppose weight of x not given, weight of y not given, but they have given correlation of xy is -1. It is negative correlated. Now the question is, what should be the weight of x or what should be the weight of y so that the overall risk is minimum? Friends, this can be done in two methods. Alright, just write down this in your books. Method 1 is what I call it as trial and error method, or we do it by guessing. Second one is formula method. Alright, can you please write down till here in your books? Thank you, MM Kurvila. Alright friends, I will quickly show you first using trial and error method so that you understand the common sense, and then I will show you using formula method. Alright, so I will again take MS Excel. I will take a fresh sheet. Okay, I'll just make it big so that you all can see it clearly. What I'm going to do right now is I'm going to put SD of X. I'll put everything in capital. SD of X, standard deviation Y, weight of X, weight of Y, correlation of XY. Alright. We know, or I'll just give a heading before this called as situation. Alright. Situation 1, 2, etc. Standard deviation of X is 10, of Y is 10, weight of X for time being I don't know. I will start with weight of X being 0 and weight of Y being 100%, assume. Alright, and correlation is already given as -1, am I right? So to find out the combined risk, I will first do what? Standard deviation X into weight of X the whole square, or I'll call it as X square. X square, here I'll find out Y square, then here I'll find out 2xy, then I will take the total. Alright, so these intermediate columns are not very much. X square is nothing but standard deviation X into weight of X the whole square. Alright, this will be standard deviation Y into the weight of Y the whole square. Alright, this will be 2 into standard deviation X into standard deviation Y into weight of X into weight of Y into correlation of XY. Once I get this, this will be nothing but this plus this plus this the whole square root. Am I right? So I'll start with an equation square root of this. So here the combined risk turns out to be 10. I will now take and I'll show you 100 permutation combinations wherein, let me go down. Okay, I'll show you till here, wherein I will keep rest everything constant. For example, these two things will be constant for all the 100. This keeps on changing. Correlation will also remain constant, and this formulas will remain constant. All right. Now the only thing which will go on changing will be here. It will be this plus 0.01, or it will change by 1%. Are you getting my point? So I'll just change the format of this and this into percentage. Alright, and this will be this -1. Alright, let's remove the decimal points. Alright, so here it would be 2, and like this it will go on going up till 100. And this one will be this minus 0.01, that is 99, 98, 97, like that it will go on decreasing. It will go from here, it will go up to 0, or it will go up to 99.1 at this point. Alright. So now friends, these things are something which is for me to do the calculation. I'll hide these things so that we can focus on what is actually relevant. This is the combined risk. Okay, so this is the column which is actually relevant for us to understand. If you see from 10, it is going down 9.8, 8, 7, 6, 5, 4, 3, 2, 1. At this point, it is actually 0. 10 into 0.5 the whole square plus this turns out to be 0. Then again it's going up 0.2, 0.4, 0.6, 0.8. So can I say at this point, okay, that is situation number 51, my overall risk turns out to be 0 or the minimum compared to all the other permutation combination. So when the standard deviation of x is 10, standard of x is y is also 10, this is 50-50 and here it's -1, my overall risk turns out to be 0. So using trial and error method, I have got the answer that the weight of x should be 50%, weight of y should also be 50%. Now we can find out the same answer using formula method also. Alright, formula method actually goes like this: a square minus ab divided by a square plus b square minus 2ab, or it will be weight of y is equal to a square will be variance of x minus ab will be covariance xy divided by variance of x plus variance of y minus 2 covariance xy. You must observe when I want to find out weight of y, I start with x. So if I want to find out weight of x, I should start with y. Variance of x will be 100 minus covariance xy. Let us find out that over here. -1 correlation is equal to covariance xy divided by 10 into 10. So I'll get the answer as -100. It will be 100 minus -100 whole divided by 100 plus 100 plus minus 2 into -100. Am I right? So I'll get the answer as 200 divided by 400. I will get the exact same answer as 50% which I got earlier. So hence proven that we will get the same answer whether we use the trial and error method or we use the formula method. Can you please write down this in your books now? Alright friends, have you all put up till here in your books? Okay, with this we are done with this part of the chapter also. Let us now go to the next chapter, which is business valuation. Friends, here I'll be only focusing on the exam point of view, but practically this is a wonderful area. Lot of chartered accountants, including me, focus and I practice intensely on this one area. So not only in India, I have offices abroad also in Dubai and in Bahrain. Even in those places, business valuation is having a huge role. So just than learning it from exam point of view, please learn it practically also. The videos are there in my website. Now since time is short, I will be giving you only from exam point of view. All right, friends, basically this is having only one question: how to value a business. As per the ICI guidelines, there are mainly the following five methods which can be used. The first method is known as net assets method. Second method is known as dividend capitalization method. Third one is called as earnings capitalization method. Fourth one is called as free cash flow method. Fifth one is called as free cash flow to equity method. Can you please write down this in your books now? Alright friends, now here I will just mention net assets method is basically nothing but assets at book value minus liabilities at book value. Dividend cap method is nothing but D1 divided by KE minus G, which we already learned in the chapter of dividend policy. Earnings cap will be similar to dividend, it will be E1 divided by KE minus G. So the only difference will be instead of D1 I'll put E1. These two parts, free cash flow and free cash flow to equity, is what we will focus on now. Once you're done, please chat and let me know that you're done. Alright friends, shall we now do the most important two methods? Friends, interact with me. Let's go back to Chop Shop. Yes, Susan, Chop Shop is not a part of ICI guidelines. It's just a general method just for checking the proxy company details. Alright. Chop Shop, the logic is there in my website. You can click and you can learn the logic. Not very important, hence I'm not covering it right now. Alright. Friends, now interact with me. We'll go back to the basics what we learned yesterday. How do you value any asset? It is nothing but the present value of future cash flows. So a value of a business is also nothing but the present value of future cash flow. So value of business will basically have two parts. First part will be future cash flow, all right, and the second part will be the discount factor. Can you please write down till here in your books? Alright friends, now this value of business can be found out in two point of view. That is where the whole perspective will come. I'll just go to the next page. Value of business can be found from two perspectives. The first perspective is from equity holders and debt holders point of view. So both of them together, the overall investor's point of view, we can find out the value of business, or we can find out from equity holders point of view only. That also we can do. This is what we call it as free cash flow method. This is what we call it as free cash flow to equity method. Can you draw this chart in your books now? Alright friends, so now I will write down the first one. Value of business from both equity plus debt point of view. Let's start with this. So here I told you the value is nothing but present value of future cash flow. So we are having two parts over here. One is cash flow and the other one is discount factor. For cash flow, we have already learnt a formula, friends. Here the cash flow will be profit after tax but before interest. Why before interest? Because we are thinking from both equity and debt holders point of view. Plus depreciation minus capex minus additional working capital will give you free cash flow. Is this not something what we learned in the basics, friends? Same thing applies to proper professional business valuation also. That's why I kept on telling that it's very crucial that all of us understand from a practical perspective, and the basics are very, very crucial. Now discount factor, we are thinking from both equity and debt holders point of view. So the expectation will be WACC. This is nothing but KE into weight of equity plus KD into weight of debt. Now let me explain one thing practically. KD is okay. W weight of debt I can get from the balance sheet. Weight of equity I'll get from the balance sheet. How will I find out KE now? Friends, I can use CAPM formula, that is RF plus beta equity into RM minus RF. Am I right? Now tell me, RF is a bank FD rate I can get from any bank. RM I can get from the market. How will I get beta equity if I am an unlisted company? Friends, if I am an unlisted company, I can find out the beta of my company using proxy beta. 4 steps. Beta equity of MT Educare, overall beta of MT Educare, overall beta of RPL, equity beta of RPL. So friends, whatever we learned so far, everything comes in this business valuation. Can you draw this chart in your books now? Yes, Shubham, KD, everything will be after tax. If the cash flows are after tax, discount factor also will be after tax. Friends, I hope you have written down till here. Now I'll go to the next one. Value from equity holders' point of view. Okay. So when you say we have tried to find out the value from equity holders' point of view, again I have two questions over here. One is cash flow, other one is discount factor. Now the cash flow will be profit after tax, after interest. I don't need to mention this actually. After tax means obviously it is after interest. Plus depreciation attributable to equity holders only, less capex attributable to equity holders only, less additional working capital attributable to equity holders only. What is this attributable? You will understand once we solve a problem. This will give me free cash flow to equity. And here the discount factor will turn out to be what? Only KE, nothing else. Alright? Can you write down this also in your books now? Alright friends, have you all put up till here in your books? Excellent. Now let's go and crack a problem on this. Yes, this question number 4. I'll give you a minute. Can you read through this question and understand this question, friends? After which we will solve it together. Friends, here all the data is given in the table, so we only have to find out the analysis part. We don't have to write down the basic data. They have given revenue, EBIT, CAPEX, depreciation, and they have given a lot of data below. Down they have given RF, equity beta, market risk premium, etc. From that I can find out CAPM return or the KE, and from pre-tax cost of debt and debt equity ratio I can find out KD. So basically I can find out WACC. The next working note heading will be WACC, particulars, high growth, stable growth. Okay. Point number A, I can find out KE, or the formula for KE will be RF, that is 10, plus beta is how much? 1.15 into RM minus RF is given directly as 6. Okay. That will be 16.9%, and the second case it will be 9 plus 1 into 5, that will be 14. I can also find out post tax KD, that will be 13% minus tax rate is 30%, so I'll get 9.1, and the second one would be 12.86 minus, that will be 9%. I know the debt equity ratio, that is 1:1, 2:3, so I can find out the WACC, which turns out to be 13% for the first one, 12% for the second one. Can you please do this on your own, friends? Mergers, the chapter's name is Mergers, Siddesh. It is there in Mergers. Inside that you will be seeing that. Yeah. Alright friends, have you put up till here in your books? So friends, we have two parts, future cash flow, free cash flow and discount factor. We have got the discount factor, now we have to find out the free cash flow. So I'll write down working note number 2, free cash flow. Okay. Year 0, 1, 2, 3, 4, 5. These 4 years are high growth phase, and the last one is a stable growth phase. Okay, they have given the revenue over there. How much is the revenue given over there? 2000. We will give it in crore. We are having then EBIT, that is 300. From this I can find out EAT, that will be 210 after tax, plus depreciation. Rangesh Badri, it is not 11%, it's 12%. You got 11 because you didn't do debt equity, you did equity debt ratio. That's why. Okay. Depreciation is 200 minus capex is equal to 280 minus additional working capital is 25% of 2000, that will be 500. Friends, this cash flow I will not find out because value of a business is present value of future cash flows. It is not present value of past cash flow. I will only determine the remaining months. Now they have told that revenue is growing by how much percentage? 20%. So my numbers will be 2400, 2880, 3456, 4147.2 into 10%. That will be 4562. Okay. EBIT would also, EBIT is not relevant, we just need to find out EAT. So I will do only for EAT. EBIT you can ignore it, that was only to find out EAT. 302.4, 363, 435, 478. Depreciation also 20%, right? Yes. $240, 288, 345.6, 414.7. Last they are saying it will be offset with capex, so don't put anything here and here. 336, 403.2, 484, 581. Friends, additional working capital will be only the additional one that I will take. So that will be 2400 into 25%. How much is the working capital requirement tool? 25% of the revenue, right? So 2400 into 25% is 600. 600 minus 500 will be 100 only will come over here. The additional, okay? 2880 minus 2400 into 0.25. 120 over here. 144 over here. 172.8. And the last one will be 41, sorry, 103.7. Alright, from this you can find out the free cash flow on your own. Can you please do this on your own now? 56, 67.2, 80.6, 95.9, 375. Here Siddesh, changes in working capital, we take only the additional ones. We don't take the total working capital because total is already paid. 500 was already spent earlier. Now only extra how much is spent? 100 extra is spent, right? So it's like 2400 minus 2000. Additional revenue is how much? 400 into 25%. Next one is 2880 minus 2400. Additional 480 into 25%. Like that. Can you please try it now? I'll just fill some water and get back. Once you're done, please write and let me know that you're done. Friends, tomorrow I'll start with international finance. Please go to my website, view the videos and come. It will be much more easier for you to understand it. And in 5 hours, we can cover maximum. Alright? Alright friends, now here one challenge is there. Value of the business is present value of future cash flows. Here there are two types of future cash flows. One is high growth cash flow, other one is stable cash flow. So when you have two types of cash flows, we solve it using a model called as two-stage dividend discount model, which I'll explain to you along with the question. Alright? The next working note will be value of business using two-stage dividend discount model. Alright, so here I will go one by one. Stage 1, present value of high growth cash flow. Here cash flow, discount factor and discounted cash flow. So year 1 56, year 2 67.2, year 3 will be 80.6 and year 4 will be 95.90. The discount factor will be 13%. You have to find out the discounted cash flow. Alright, please do this till here on your own, friends. That should be 215.80. Alright, let everyone complete this. Okay, little bit round off is okay. You got 217, I got 215. That's okay, no issues at all. Alright friends, once you are done with this, I will go to stage 2. Present value of perpetual cash flow. Alright, fine. Here we know the formula for perpetuity. P0 is equal to D1 divided by KE minus G. Here we are having cash flow at the end of year 5. Am I right? Divided by, we have WACC minus G. Am I right? This will give me the price at the end of year 4 only. So P4 will be Cash flow at the end of year 5 is how much? 375 divided by 12% is the growth rate over there, minus 10 percentage. So 375 divided by 2 percentage, I will get the answer as 18,750. I don't want P4, I want to get P0. So for getting P0, I will take present value of 18,750 discounted at 13%, not 12, because the moment it reaches fourth year, it is high growth phase. So we use 13 percentage. Okay, that will be 18,750 into 0.61. I'll get the answer as 11,437. Can you please write down till here in your books now? Yeah, Manikam Gobinath, I didn't do EBIT because what is more relevant is after tax. So 300 plus 20%, yes, that's what you're supposed to do. I never did that. I kept EBIT blank, not relevant, because what is more relevant is EAT. You can do that, nothing wrong. What you have done is correct. Can you please write down till here in your books now? Start counting. Are you done with this, friends? Kirtana, fifth year cash flow goes towards perpetuity. So we take the present value using perpetuity, we get the present value at the end of the fourth year. Then from fourth year, I am taking it to year 0. See, there is the same logic. First, the cash flow at the end of year 5 will give you P4. Fourth year is which phase? High growth phase or stable growth phase? It is high growth phase. So high growth phase, the expectation is more. More risk, more expectation. You are expecting 13%. See, for me, year 1 I might expect 13, year 2 I might expect 12. So when I am discounting my cash flow, for year 1 I should use 13%, year 2 I should use 12%. So the cash flows which come to year 1, they have to be discounted at 13% only. Alright friends, once you are done with this, I will then write down conclusion. Value of the firm is equal to, it will be 215.8 plus 11,437. I'll get the answer as 11,652.80 crores. Can you write down this and finish it off, friends? We are done with today's session. I know you're all exhausted. Alright friends, tomorrow we'll start with international finance. Okay, we'll do one more question of free cash flow to equity method, which is a small question. It will take maybe 10 minutes tomorrow. We'll do this first at 7:30 in the morning. After doing this, we will start off with international finance, friends. Okay, so please have a good sleep and come tomorrow and at least view the first 5 videos which is there in my website for international finance. Why I'm saying that is because those videos are all basics, and once the base is strong, advanced problem solving will become extremely easy for all of you. Yes, Ruchi, your doubt is why can't we take 5th year and discount at 12% only? Why do we have to make it at P4? Ruchi, the point is 5th year you have 12%, but when it comes to 4th year, the rate changes to 13%. You can't just take 5th year directly to year 0. 5th year, 6th year, 7th year, every year is ideally turning out to be nothing but 12 percentage. So that whole perpetuity, we take the present value, we get some value that comes at the end of the fourth year. Fourth year, what is the expectation? 13%, then we should go and do it based on 13%. Friends, portfolio, whatever we learned today, if you see, all the logic is available here. Logic of diversification of risk, actual return, covariance, combined risk, dominance, alpha, expected, SML, characteristic line, whatever we learned, everything is available. Tomorrow we are doing international finance, currency, commodity, DQ, IDQ, bid, ask, spread. These three videos at least. Please go through it. Only after that, tomorrow's class you will find it more enjoyable and you will understand. The remaining videos you will see much better for me, friends. But at least please view these three videos. Alright. Now friends, before I wind up, I'll just take 5 more minutes of your time to share one lesson which has helped me a lot in molding myself. I hope that will help to mold you also. Whose name have I written on the board? Muhammad Ali. Who is Muhammad Ali? Muhammad Ali is one of the greatest boxers of all times. As a kid, he was a black, and being black, he was always bullied and harassed by his colleagues. One day when he was around 12 to 13 years old, a group of 5 to 10 seniors caught him. They went to bully him and they were about to hit him. By way of self-defense, what Muhammad Ali did was, he took a stick, started hitting them back. And that was the first time Muhammad Ali started fighting back. He says, after that, I never stopped fighting and I kept on fighting. At the age of 16, he joined professional boxing and he started training vigorously and he became one of the best boxers that the world had ever seen. At the age of 22, he reached the finals of the heavyweight championship, and that is when the entire world is coming to know there is a guy called as Muhammad Ali. Nobody saw the 6 years, but when he finally reached the finals, people started interviewing him. In one of the interviews, one of the news reporters asked Muhammad Ali, Mr. Ali, are you not afraid that tomorrow you are going to fight against the unbeaten heavyweight champions of all times? Muhammad Ali did not reply back normally. What he did was, he grabbed the mic from the news reporter, went straight in front of the camera, started speaking to the opponent and told him, come and fight me, I will break you down. The moment he spoke so confidently that tomorrow he is openly challenged the heavyweight champion of boxing, everyone became alert. Everyone started getting excited. Many thought this fellow is just talking and he's not someone who can perform. But the next day, the ring was houseful. People were waiting to see this young chap fight for the heavyweight championship. You should see the way Muhammad Ali comes to the ring. He doesn't normally walk and come. He will dance, he will jump here and there, and he keeps on screaming, I am the greatest of all times. I am the greatest of all times. And when he finally got into the ring, he did not stop there. What he started doing was, he started looking into the eyes of the opponent and went on speaking, come and fight me, I will break you down. Come and fight me, I will break you down. And finally the match began, and you should see this match. It is there in YouTube, the way Muhammad Ali fights. When the other opponent tried to hit him, first 3 rounds he was teasing the heavyweight champion. He was so quick in his response that the heavyweight champion couldn't even touch him. He will just move off his head and tell him, this is all that you have got, come and hit me. Again he will try hitting, he will dodge. After the 3rd round, 4th round, this fellow started hitting back brilliantly, left and right to the other fellow. By the end of the 6th round, Muhammad Ali won the heavyweight championship by way of knockout. What do you mean by knockout? It means he won by the other fellow falling down and counting off 10. And that is when people suddenly started respecting Muhammad Ali. They suddenly started asking him, Mr. Ali, what is the secret to your success? How did you do this? At the end of his career, Muhammad Ali shared 2 things. He said these were the 2 things which I kept throughout my life. The first one, what he said is, look in the eye. And the second one, what he said is, start counting when it starts paining. When he was interviewed, they asked Muhammad Ali that, weren't you afraid when you were getting in the ring? At the end of his boxing career, he accepted that yes, when I'm inside the changing room, I'm very much afraid. I don't even feel like going and boxing. So when I start walking, first I need to have confidence in myself. only then I can have confidence in, fighting in the ring. So I will start screaming loudly, I am the greatest of all times. I am the greatest of all times. So people who listen to me, they will also believe, I will also believe. Then when I get inside the ring, I will look into the eyes of the opponent. I will not blink. I will go on telling, come and fight me, I will break you down. Muhammad Ali says, in all the matches that he has won, there will be one single moment when the opponent will either bend his head down or he will slowly blink his eyes, which will give the signal to Muhammad Ali that in the mind he has already won the match. Now he has to only go there and fight. So the first lesson what Muhammad Ali taught me is that we should believe in ourselves. We should have the guts of looking into the eye, because only if I believe in myself will the world believe in me, and only if you have the guts of looking into the eyes you will be strong enough to fight, because fights are first won in the mind and only then fights are won in reality. So friends, this is the first message to all of you: look into the eye or believe in yourself. The second lesson was when the interviewer asked him, Mr. Ali, how many sit-ups do you take every day? Normally people will reply, I do 5 sit-ups, 10 sit-ups, etc. But here Muhammad Ali said, I do not count my sit-ups. I start counting only when it starts paining, because that is the time when the real benefit takes place. An amazing lesson. So when normal people, after 50 sit-ups, they get tired and they stop. That is when this fellow starts with the first number of count, and he says that when others break down, I stand up. That is the time when I have value. If I do the same thing what others do, I have no value at all. So I should start counting only when it starts paining. So friends, as CA students, these are the 2 lessons that I can share with you today. Rule number 1, believe in yourself. Do you know 90% of the CA students who fail are not the ones who are less hardworking. They are the ones who lack belief in themselves, who don't even have the confidence of telling to themselves that yes, I can do it. So friends, if you really want to win, start believing in yourself. You have got a very, very powerful mind. Anything is possible. CA is just one minor thing. I'm not exaggerating. It's all up to your mind. If you know how to use it and if you believe in yourself, only then will the world believe in you, and only then will you be able to score great marks. And second lesson what he taught me is start counting when it starts paining. If you do the same thing what others do, you have no value. But if you do something what others do not do, that is where you create real value for yourself, friends. So start counting when it starts paining. When others break down, you stand up. That is where you create value for yourself. So these are my 2 lessons to all of you, friends. Believe in yourself and start counting when it starts paining. Thank you so much for your 5 hours listening today, friends. See you tomorrow morning at 7:30. Have a nice time ahead. Thank you so much.